Trade ATS. The following video is a compilation of clips taken from the last few months of the Trade ATS weekly live webinar. Specifically, every time that we've mentioned either the basic strategy or entry in general. So we're hoping that for those of you that are a little bit newer to the software, this kind of condenses all of it down and makes you a little bit more confident when picking an entry with the software and managing risk on that entry. That being said, let's go ahead and jump into the clips.
We broke out on, okay, so we basically broke out through here. Had a possible entry right here, up through expansion, came back. So we're getting kind of a classic expansion pattern here. Expand low, or expand high, expand low, expand high, expand low. In these situations, this is that whole master pattern, ideal situation playing out. One thing that you got to do when you see this expand high, expand low, this whipsaw action going on, the way you don't get destroyed like most other people do in this situation is you're only trading one side of it. You're only trading the buy side. So right here, you buy this, you buy this. You're only buying, and the reason you're only buying is because you're stabilized in your supporting time frame. We expect that when we get a breakout short out of the box, that this is one half of the whipsaw, and the other half is going to come because the directional bias is long. So we expect that whipsaw to some degree. That's why we buy below expansion. That's the tipping point. We're expecting that the higher time frames going to basically kick in, and we're going to catch that expansion leg back up, even if it's the whipsaw action. That's the way we're trying to get put into the money in those situations. So there was good opportunities there. If you caught this one at the rotation puts you in the money. You're above expansion right here. This one, you're probably expecting, more to come out of it, but it does come back. In these situations, if you don't close up here on the liquidity line, especially if you're trading the 1 hour, you're looking for more pips than just from here to here. Typically, you're looking to get a decent run out of it. So, on this one, I'd call this a break even realistically for most people, because it's going to come back. When you're above expansion, you already caught it even close to here, but it's already put you into profit. You don't want to give that back. When you get back down to here, you're closing, break even, get back in down here, or see what happens as it breaks through. You got a liquidity line here. You're rotating off the liquidity line. Your higher time frame still intact. You're buying again right here. Get back up. Now we're back up through expansion. So the profit we're looking for initially is from here to here. Now you're up through the expansion level. You got some architecture forming, but you notice even as you broke low out of this box, it held this level. So that's what we want. We want to buy under expansion, get through the expansion you're working with, and then hold above and let the price, even if it goes sideways, we don't want this wick to really go below this level. That's where we're going to manage it. And then now you've legged into that trend on the daily. Now, if you did catch this entry, once you're in profit, now you need to start asking yourself, what's the potential of the daily? And you can look at the previous liquidity lines for profit targets. But right now, if you're in this trade, you should have a profit protected, somewhere in the realm of in here, depending on how this looks like it was pretty aggressive turn. But you're probably, somewhere in here, and you're protecting your profit above here. So pretty much your stop goes right here. You lock in those profits, and you pretty much ride this for whatever it's worth and try to manage, what you're getting here in real time with this new architecture. You want to see that you're still stacking boxes long, that generally the price action's holding above the last expansion lines. It's all giving you clues that are in the favor of your trading idea, which should be long. So until those clues start changing and going against you, then you start thinking, okay, should I get out? Possibly. But overall, that's your leg in was down here from what I can see. So, but yeah, it's pretty textbook. Below expansion, we're selling. Above expansion, we're buying. And you want to catch it when it's fresh. Right now is the time where you want to catch it. This could turn into 10 days of a run very easily. we could run all the way back up to this expansion level, but the key is figuring out what's going to happen when you're close to the expansion box, when you're close to the contraction box right here. You don't want to, like this one right here, you got below on this candle, we had a new expansion line, boom, you're trying to find an entry in this neighborhood, there it goes. You don't want to watch this go and then start getting aggressive right here, because you're already, how far away are you from that expansion level? It's already pushed a significant amount. Now, I'm not saying don't trade it, but what I'm saying is don't go heavy. Don't put all your chips on the table after you haven't gotten any of this. If you got a lot out of this, well then fine, you've earned your right to really trade the trend for all it's worth. But don't see something that's ran 2, 3, 4, 500 pips and then start going heavy just because the probabilities are starting to fall out of your favor. You want to catch it early. So anyway, it seems like a pretty good setup. Like I said, the only way I saw to leg into this and sustain was on this rotation right here, off that liquidity line. And if you nailed that, then you're pretty much, you've earned the right to see what this thing pays. If you want to stay in, stay. If you want to move your stop up as you get new architecture, maybe we get another big run. If you do, I'd probably take my stop and maybe put it up in this neighborhood up here at these expansion levels. And try to lock in profits based on the architecture. The market's going to determine what the deal is. So as the market lays down the architecture with the boxes, with the expansion lines, we have no choice but to adapt. We're not going to impose our own, traveling stop loss, or trailing stop loss. We're not going to try to, you can use those things if you want, but overall, the market's going to tell you what the sensitive points are. It's up to us to identify them and work within those boundaries, and it'll just be what it's going to be. So, all right, so let me look at the other
pair. So going back to picking the overall direction that you want to trade, I've been trying to think of the simplest way to put it out. When you look at your higher time frame, you're just trying to picture what's going to happen next on that trend. If you got in somewhere in the middle of this push down, then you're trying to look for an entry that would best allow you to test if it's going to go down. So that's where the master pattern gets really important. If you think that the market is still going to go down short, then you're looking for the highest entry that you can get into while managing your risk to get into this going short. So we had a pretty good short move all through here. So you're just looking for that one opportunity inside of all of these candles back and forth that will best allow you to get into this short market if you still believe it's going short at this point. In this case, the very first master pattern that we had right here on the way down, price push down. We had a master pattern form right here, expand low, expand high, and it ended up holding off of this previous expansion line. Now, in this case, you believe that the market still might be going short. You don't know if it is, but that could be a good level to test your entry. So not only are you at an expand high inside of what you believe is a short trend, but you can also manage your risk off of this. Even if you don't hit it exactly, price pulls back a little bit, you can set your stop right above that because you had a previous reaction to this level. And that's really the gist of what we're trying to do. Just get in, above expansion on your lower time frame, below expansion on your higher time frame. So we're in a short market. You think the market is pushing. And then when you see price pull back and you see a reaction to a previous level, then getting in right there. And then even if you missed that one, so that was our first origination point. Expand low, expand high, push down. And then if you missed that one, it gave you another opportunity because it came back and tested that same origination point right here. So again, you don't know that the market's going to keep on going short, but if you're going to test an entry because you believe that the next candle is going to be yellow and push down further, then that would be where you test your entry and you can manage your risk just a little bit above that. Also notice, that expansion, we're pushing down short, still trending, still pushing new lows. and then we form a master pattern right here. That's also the highest, or one of the higher boxes inside of this range, and then we get a reaction off of that, expansion line. So that's going to happen pretty often if you're looking at it. Kind of the main point that I wanted to go through, all of this stuff, sorry if it got a little bit muddled, but a key takeaway I'm hoping you guys get out of this is, if you're looking inside of a range, pay attention to the lowest and highest expansion lines and boxes inside of that range. Those are going to be the really reactive levels. We can see we had a origination point right here after pushing the lows. So this is kind of a new little range. Price pushes up, we form a box right here. That's at, kind of the new high of this range that we've got, and then price pulls back. This one wasn't quite as clean. It was a few pips away, but then rotates. So that's going to be very common inside of a ranging, or inside of a trending market while the trend is still going on. Again, once you potentially take out your target, like we had down here. So if price pushes to the point of least resistance, that's going to be the liquidity lines. That's why we use them as our targets. So price push down, and if we think, we don't know for sure, but we think, okay, that's probably going to be the low of where I think it's going to go. It's pushing, push through there. Maybe you try one sell entry through here. It doesn't quite work out. It's like, okay, well, and it's pulling back, not really making new lows. I want to try it high. If you're going to do that, then just get in on an expand low on a new master pattern. Doesn't matter which one. You're just testing an entry. Even if you're right about the direction, it may not be that initial snap that you're getting in on. So you're just testing entries. And if you're going to test an entry, get a strong position to do so. So pretty unlikely that you'd get in right here, as nice as it would have been. But you can certainly test an entry here if you're still trying to go short, and then maybe you see there's a reaction to this previous line and you're not really feeling great about it going short anymore. Then you start looking for expand lows to test a long entry on, or a reaction to a low liquidity line to or a low expansion line to test an entry on. This one was actually interesting. I was hoping that this would happen while the webinar was going on, and then we could look at it while it was happening live. But right here, this one was very faint when it took off. So we had a new master pattern right here. We were starting to push up long. Master pattern forms. We had an expand high, expand low. Now, if you're looking, that happened right in this candle, and we're already not pushing. So that could have been a potential time to at least test an entry. Maybe not at the wick, but starts pulling back up into it. You know that it's already a master pattern. Then we pushed up long, and you can see very faintly on this candle, we actually bounced right off of that origination point. So price pulled back and bounced right off of that origination point, and then started pushing up long. And then we took out liquidity, formed another master pattern, expand high, expand low, take out liquidity. So if you can align your entries with other things happening, not it just being under the expansion line, but also taking out liquidity or bouncing off of another expansion line, something like that, that's always going to be a better option. So yeah, expand high, expand low, and then just managing to get into a trade somewhere in here inside of what might be a reversal in the market trending up. So again, just to kind of bring it all home, we don't know exactly what we just trying to stack the probability in our favor by looking at the overall trend. At some point, that trend is going to end, and it's usually going to be around one of the prominent points. So if you can just try to get in at a stronger position at an expand low, or expand low if the market's going up, or an expand high when the market's going down, then that just gives you the opportunity. Even if you're wrong about the direction, you still have an opportunity to take some profit out of it. Like maybe you were able, you tried taking this expand high, low, and then you saw that it, took out this liquidity, wasn't really pushing, bounced off of this. A few things happened through here that you weren't really happy with, then you still have the opportunity to take off, take out your trade and get out with a little bit of profit. And then, every now and then you'll hit the perfect entry, and then that just happens to go in your favor and keep on pushing for you.
Okay, long on the 4 hour. Entry right here on this rotation. Don't know if you would have got it. I mean, you can get it if you see you're holding a previous level of structure right here, like at expansion, you can get it right there. But most people are not going to, they're going to hesitate to pull the trigger. So we'll call it right here. Managing the trade right now. If you bought it right here, you're generally, there's two management points I see right here is you could manage it like right here below the rotation, which we did. Sometimes you'll notice that it does come and test that. Or you can look for the previous levels of structure. Pretty much you see that we held right here. So putting a stop loss in and around this level probably would have been, the better place to do it just to be safe. Of course, this is hindsight, you got to work through these things in the moment. But let's just say you did buy right here. You may have got stopped out. But if you see the reaction and you see that we're holding and we're still holding above this reaction point right here, you could have got back in on this last breakout right here. One thing you got to keep in mind though is that we are coming out of session. So you can still get in this trade. We still may get some breakout long here, and it'll put you into the money, but it may go sideways later. So just keep that in mind, is that volume's kind of falling out of favor here. So in a situation like this, you'd be looking to get in the money pretty quickly, like you are right now if you would have bought, on this rotation. Breaking out long out of the box, you're trying to get up through here. If you can get up through this level before the volume really falls off for the day, then I would, at that point, you've kind of earned the right to let it run through the afternoon session. But like I said, what you're looking to do definitely is get through this expansion, and I would say stay above this expansion as well. You want to see that you're working within these two expansions, even if it swims sideways. Eventually, hopefully, it'll break long and put you into profit, because the 4 hour is definitely long. The overall trade looks like there's a good chance that we can come up and hit this expansion level right here. That would be kind of my initial profit target. Overall, we're in a long trend. You can see we had a big reversal down here. So I would say it's extremely reasonable that we would at least get to here. So how many pips is that from where we're at? About 60 or so pips. Worth it. Risk right now. Since you're above expansion, I'd probably manage it, right below here, looking at how it's forming. So right now, if you got in, say right here, and your risk, you got about a 15, 16 pip risk to make a potential 60. It's not bad.
So looking through here for an actual entry, I've got the daily and the 1 hour up. This is mostly what was going on. This little range that we had through here is mostly what was happening throughout last week. Again, just kicking back and forth, which is a very, very common behavior for once price hits an expansion line for the first time, you'll get a reaction to it, and it'll either whip back and forth and continue pushing through it, or it will whip back and forth and then rotate off of it. So in this case, we rotated off of it. So once we had that reaction, we started pushing away, come down. We were underneath our expansion here, and we can see this prior expansion line right here on the lower side of this little range that we set. We started reacting to that guy. So once you saw that reaction, that could have been, an indication that we were holding above that, and buy orders were being protected at that point. So getting in under expansion on your entry time frame, over expansion on your direction time frame, that's about as straightforward as it gets as to a long market. And then you could have managed your risk if we got significantly below this expansion line. So we can see we've got nothing but wicks just coming through that expansion line, rolled off of it, and here we are. And pushed to one liquidity line. Looks like we went through a breath right there, and then pushed on up to the next one. So something interesting right here, you'll notice that sometimes these expansion lines will push up through them, and then you'll see a little bit of a reaction there as well. So we had that in this case. We pushed up through the expansion line, and then we kind of held above it. So, you know, sometimes in certain situations, you might find that if you're not able to get in down here and, you know, this is still kind of a breakout situation that, you know, you can manage your risk off of these expansion lines. There's a really good example of that on New Zealand dollar right now that we'll get into here pretty soon. So let me go ahead and switch this over to a little bit smaller time frame. Oh, what's up?
I was just going to say, just to follow up with what you're saying, you know, this is the pound NZD on that daily chart. That's really in the volatility report. That's really the ideal situation that we're looking for when we put that report together, because like Shane was saying, you're so close to the decision point on that daily time frame, and you know that daily, you know, the price does not like to be at expansion levels. It's like it wants to, it gets magnetized to those levels, and then it wants to react. It wants to go either long or short from those levels. So, you know, that's really the sweet spot, especially when you can spot that on a higher time frame. You know, you can definitely line yourself up to take some decent sized gains off of you know, off those levels, just because you're so tight to the decision point. So anyway, it's definitely an ideal situation. And it's still not done, you know, it's just pulling away on the daily. So you know, should the daily close green, you know, the rest of the week, you know, there's definitely a good possibility we could still be climbing up long on that trade. However, there isn't any great entry opportunity right this second. You'd want to wait for the hour to reset. You want to wait to get a new box on the hour, you know, get some more architecture at the higher price level before you'd actually want to act on that trade. But it is taking off, so it's definitely one to watch. All right, the basic training videos in the online course, the basic strategy videos, and just watch them a number of times, because there's a lot in there. But basically, the steps are really simple. You have your time frame pairing. And I'll just tell you the time frames that I would stick with. You could do what you want, but if you're trading shorter time frames, 5 or the 15 into the 4 hour is good, and use the daily to back up the 4 hour if you're trading in session. So 5 or 15 into 4 hour, use daily to confirm 4 hour. Follow through. Make sure that your 4 hour, if it's above expansion, you're only looking for buy trades. If it's below expansion, you're only looking for sell trades. And then on the 5 and the 15 minute, or the 5 or the 15 minute, if that 4 hour is above expansion and the daily is supporting it with the daily color candle, then you're going to be looking, if it's above expansion, every time the 5 minute gets below an expansion, for instance, or like right here, 15 minute, you can see the 4 hours above, 15 minute forms a box, we go below. This is where we get into criteria. The minute you break through this box, doesn't mean it's ready yet, but that's where we get into criteria. Now we're looking in the zone between here and a previous expansion level. You're looking at the overall architecture to find where the possible rotation point is, because at the end of the day, what you're counting on is that the 4 hour is going to follow through, that you're going to get another green candle and it's going to surpass the high. All we're trying to do is find a safe entry into the trade over here. So remember that the trade is your higher time frame. It's over here. That's the trade. This is just a tool to find entry on the lower time frame. And it's just whether you're going long, you're going under expansion, if you're going short, you're going above expansion. But it all starts, in order to find a trade, the number one most important thing that you must start with is you have to figure out, you have to feel almost as if that you would be comfortable getting in on the trend, or on the higher time frame with no entry. So you take away your lower entry time frame, you almost got to feel good enough that you would just jump in. You know, same thing right here where we broke short right here. You can see we came through and then we had kind of sideways action, but this is showing a rejection of this level right here. You can see that it's not turning. So that is our clue that, yeah, this is probably going to go. When you see a candle start to move past those lows right here, you would almost want to jump in on that. You'd almost just want to get in. And when you feel that way on your higher time frame, when you feel like, oh, I just almost, the same thing right here. It goes long, you're above expansion, you get down, this is a rejection of this level, even though it didn't get too close, it's a rejection. There's no interest in this market wanting to go down to here at this point. When you start seeing green right here, you would almost just want to buy this without the 15 minute as help. So when you start to feel that way about your higher time frame, that's when you jump over to this chart. Until you feel that way about the higher time frame, then you really don't want to look at it yet. So that's where I would say, as a beginner, learn how to forecast the higher time frame, and when you do that well, the lower time frame pretty much will take care of itself. And when the higher time frame starts going sideways and you feel what you feel like is a good setup, and you take a hit on it or you get knocked out, sit back and just wait to see, does the higher time frame turn into something that's a mess. If it does, we want to try to avoid these as much as possible. You want to wait for a fresh expansion, and then you'll have a fresh opportunity to trade away from expansion. Same thing is right here, same thing is right here. So that's really ideally what we're looking for. So
just to keep it real simple, if you are above the most recent expansion on your direction time frame, you're looking for long trades. And then in that same scenario, if you're looking for long trades, you want to be below expansion on your entry time frame. Here's a question, or here's one: would you enter now? Not right now. We are way above expansion on our entry time frame. The last entry that we had through here was actually this guy, because we have not been below expansion one time since then. So it would have been this, which happens to be the bottom. This just goes for the 15-minute chart. We can take a look, and maybe there's something on the 5 into maybe the hour. So it was pretty much only this. Again, if your direction time frame is long, then you want to be underneath expansion on your entry time frame.
I think
here's one from all over. If you're already above expansion on the entry time frame but not far away from it, could you still enter? It's not ideal. Sometimes you're going to have a breakout situation, similar to this, but
Shane, to pick up on that comment, you can, in some of these momentum moves that just really take off, you can enter above expansion, but you got to realize that if you're going to do that, you want to be as tight to that expansion level as possible. And guys, there's no, ideally you want to be below expansion in a uptrending market on your higher time frame, but understand what the expansion lines are. Those are the decision point. So if it goes below that, you have to start asking different questions about what the future of that opportunity is. So that's why you want to manage your trade in and around that. So if you're going to buy a breakout on a box, understand if that breakout fails and it doesn't go, then it's going to come back to that expansion level. And if it rejects the expansion level and keeps going in trend, well, then that's great. I mean, that's in the direction of your original trading idea. But if it gets through there, you got to ask yourself what's going on here. And so you got to be, if you're going to buy above the expansion on your lower time frame, you really want to be ready to cut it if it gets much through that expansion line, because you could be going into a bigger expansion range, and there may be a much better entry opportunity down below expansion. So you just need to be ready to make those calls, and you want to adjust your money management according to the opportunity. But just understand that white line is a decision point. Wherever you enter, if you bought right now, you're below that expansion level right now on the 5 minute. So, you're expecting it to rotate up right now. However, the move has already ran quite a bit. So remember, the more opportunities that go by, you're going to get less and less probability as the trend pays. So, in a situation like this, you wouldn't want to be going heavy right now because it's already made a nice up move. So, keep that in mind too. But just understand, those white lines are giving you the architecture of the decision points. And wherever price is when you want to take a trade, it's either going to go through those lines or it's going to hold, and it's either going to be in your favor or it's not. Just understand that those are the management points, and you just need to treat them accordingly, and structure your money management around what the risk is based off of those lines. So
one thing, this will, going to kind of throw in a few little observations. You'll see very often that when you get some weird behavior around liquidity lines, first and foremost, liquidity lines are basically how we use, what we use is profit targets inside of a trending market. So inside of a trending market, it will have a tendency, it being priced, will have a tendency to not take out one side of liquidity and kind of seek out another. So we can see that kind of behavior through here. You know, there was a very easy opportunity for price to break down, take out that liquidity line, but it didn't, and it just kept to the sell liquidity, the red sell liquidity that we see here. As soon as you start getting behavior like this, that is an indication of a little bit of odd behavior. And we can see what happened after that. You know, we did not take that out. We came back down into a range. We did end up taking it out, but you know, it basically turned into a range following this odd behavior, ending with us taking out a buy liquidity line. And we can see that we came almost all the way back to that point. So things are starting to whip back and forth now. There's a normal behavior that you can expect from these liquidity lines. In trend, it will tend to seek them out, and in a range, it will indiscriminately whip back and forth through each one. You know, it's just kind of a rule of thumb to help you kind of manage your trade, and why they're so effective as a profit target, because it'll just keep to one side of the market and keep on pushing through those. One thing that I wanted to talk about here, just, you know, this is kind of based on some of the emails that we get in, just regarding breakouts. So when price just breaks straight out of the box, I wanted to just talk about that for a second, you know, because I know a lot of people get frustrated when they see stuff like this, when it just, you know, pushes down or pushes long or short just straight out of the box. So two things that I wanted to kind of address with that is, the first one is typically when you see a breakout happen where it just pushes straight out of the box, doesn't really come back down to test, or doesn't come back to test the expansion line. Usually in most situations, there was an entry before that happened. So here on the 4 hour, we can see that we had some entries up through here, you know, nice clean rotations off of this expansion line, took out a liquidity line and started pushing down. And then right here, we had kind of a whip up long, and then it just broke away. The second thing that I wanted to address about that is, well, yeah, so just kind of in conclusion of that, if it does break away, it's usually because the entry already happened, and you know, you're just a little bit late to the trade. The second thing about that is that usually if it does break away, it's not the full piece of the story. It did break away from this pretty significantly, but did it really? Because we ended up coming back, and you'll find we ended up coming back to that expansion line right here. And you'll find that all over the place. If it ever seemingly quote unquote breaks away, you know, just has a breakout from a box, it's usually not the full part of the story. So right here, you know, if we continue going long right here, we could see this, oh, it just broke out. But, you know, if you look back through it, we already had an entry leading up into this. So, yeah, I just wanted to make a point about that. Get a lot of questions about these breakouts, and it's a little bit difficult to explain through email. Like we had a breakout right here, but we already had an entry back here where we were down below expansion, rotated off of this, it broke out, and then, you know, we can see a little bit later on with more perspective that it wasn't the full part of the story. You know, it just broke away for the moment, but ended up coming back through here, and you know, there's some oddities that happen right here. As far as actual entries go, you would have wanted to stay long through this, and kind of the best entry that I see through here. So we broke out, or broke long through here just in this little session that we've got since we broke out of the 4 hour box. This would have been a good entry right here. This was not above, or this was above the most recent expansion line, so you would not have been looking for an entry right here. But then we got a new expansion line and broke down, price whipped down short, and we had a reaction to a previous expansion line. So when you see that and it starts reacting off of it, then you can get in once you see the turn on some of these and manage your risk off of that expansion line. So that would have been the first entry into this, and we can see that it worked out pretty well. We came up, took out the liquidity line that we had, whipped back, formed another box. You could have closed if you wanted, but if you didn't, then you got a pretty nice little profit out of it.
That's really, I would say that's really ideal, Shane, that one that you're looking at. When you get that reaction off the previous expansion level, that's showing that that's giving you a clue that the trend is still intact. That's a clue. If you're trading long, you're looking for clues to reinforce the higher time frame on the lower time frame. And that right there, if it's rejecting going short through a previous expansion level, well, what does that mean for the overall trend? It's good news, right? So if you rip a long trade on that rotation on the 15, Shane, if you could go back and highlight that candle right there, or you just wait till you get that first green candle right there, where you got to ask, okay, that was the clue, is getting the rejection off of that expansion level. You're starting to see the resulting rotation, the 4 hours still long. Where would you manage your risk from on that? Right there. Because if you're wrong on that trade, it's not going to go, if it gets below that piece of architecture, it's probably turning the 4 hour at that point. So that's a low risk, good opportunity right there. And that's, there's nobody's forcing you guys to get in a trade. So if you just wait for that situation to happen, and it happens a lot, that's a good entry point right there. And that's going back to the original question of, how do I navigate the expansion range and try to find, how do I find the rotation? Well, that's how you navigate it right there. You look at the previous framework, and when you get those reactions, when it becomes clear is when you take action. If it's unclear, let it go. There's always, I remember the first guy that taught me about trading. One of the first things I was looking at his screen, and he's like, look at that move, that move. And I'm like, oh man, look at that. And look at that. It's like, you want to trade everything. But one thing he told me is like, there's always another trade. Never get upset about missing something. There's always another trade coming. So wait till the situation comes up and you have a definitive clue that's in your favor that causes you to take action, and you can manage your risk off of that level. And if it's not great, then you could still trade it, but don't trade it as heavy as you normally would. You want to save your biggest positions for the tightest risk, and if you don't have that, just, be a little bit lighter on the trigger.
Quick. So going back to this, I wanted to talk a little bit more about, what took place here. And again, the stuff that I'm talking about, it applies to every time frame. It just happens to be that we're on the 4 hour and 15, but this behavior of reacting to the price levels and, this type of entry, it's all the same regardless of the time frame you're looking at. So kind of back to what we were saying, this would have been, kind of your ideal entry into this trade, manage risk off of that, get in somewhere once you think a turn is happening, and then manage risk right off of, either the low of the previous candle or just this general expansion line. And that you're long because you're above the most recent expansion line, you're outside of the box, so you're looking for a long trade. One thing that I think is really important to bring up is this right here. So we had a breakout. And if you're in that, all is that you're, really happy at that moment, but then we form a new box. When you see something like this, if your directional bias is short, this is an ideal entry right here into a short trade. If you're sitting in a long trade and you see an ideal entry into a short position, that is a really, really strong clue to dump that trade, that something is about to happen when you see something along the lines of this. And we can see very shortly afterwards, it plummeted. And also kind of going back to what I was talking about with breakouts, that you don't have the full story, but, just ignoring that, we had a very strong clue of something, about to happen right there.
It's going to be more of an advanced trade. If you go to the basic strategy, really the run started back here. Remember, the expansion is the volatility signal. We left the box, you got a new white line, and then boom. That's really what the gravy trade we're trying to find. is on our higher time frame when this is the sweet spot right here. Same thing right here. Expand, comes up, tests, no problem. Rotate after the test. You know, that's it. Same thing happened back here. You want to trade in and around that sweet spot of that expansion. Now, let's talk about this. If you want to short this, you can do that. Looks like we had some contraction happen up here, so let's look at that on the higher time frame. So let's figure out where we're sitting on this. Okay, so I see a master cycle that on the 15-minute, we had a swing low, swing high, swing low, and now we're starting to hold below the sensitive price point right here from that master cycle. So it's going down. So here's the thing. You're still going to need to enter. Probably the only place you could have entered safely was on this pullback right here, and I don't know what the 4-hour looked like at this time. I wasn't looking at it. But this was it. You can see that you started pulling short, which this would have pulled the 4-hour short right here. So you got this short move right here, and then we come back up, test this level of structure. This would have been the best point to enter short right here. So if you're holding this kind of position on it, that's kind of your grade A opportunity, you know, would be the counter trend breakout against the 4-hour candle. And that's a reason why we let it trigger even against expansion. I know some of you guys get confused on that. Is why am I getting opportunities when it's against the basic strategy? This is why, is because you could potentially get yourself into some pretty awesome mean reversion trades back to down here that do happen quite a bit. Same thing with right here. You see that we rotated on the 4-hour. You could have wanted to take a grade A trade back up into this level right here. Same thing with right here. So that's why we let it do that, because there's some great mean reversion trades if you know what you're doing. That's more advanced, but those are things that come in time. Just through observation, you guys will see that. That if you're holding the position up here, great. Now, you know, you can get in, but again, now you're in the grade B situation, and you know, you just got to be careful. Just use good money management in a situation like this. Would I bet heavy? Again, the money is your guys' business, what you choose to trade. But personally, I wouldn't be going too heavy on a situation like this. And then also too, I'd get a better bird's eye view. Let's look at the weekly. Okay, so weekly, possibly we're rotating on here. There's a good chance that we can make the transition from here to here, just to get up, even if we just test this level. And if we get through this level in the weekly, we're probably going all the way back up to here. Just a swing low, swing high. We're going to traverse the box. That is a trading idea in itself. If you say, look, I'm in this spot, what I'm going to do, I'm going to basically take a bet that I'm going to go to here. And if I'm right, I'm going to go to here and possibly beyond. If I'm wrong, I'll know right about here. So there's your risk generally, there's your reward. Now you don't just do that. Now you can go look on the higher time frame to find clues that reinforce that idea. Again, doesn't have to, we don't know if they're going to win or not, but it's an idea. Now we find clues that justify trying to do something with it. It's all risk management. So let's figure out what's going on. So right now you're getting the signal. Look at the previous architecture. Right now we push down, we're holding at this previous expansion level, right? So before you just enter, look at the previous architecture in this overall area. I would be looking to get a reaction off of this level would be nice, to see if we get a reaction off there. See the 4-hour pull down, see it hold at this level, see it start shrinking back, then go long right there, and then control your risk under this level. I really wouldn't want to ride it. I wouldn't enter right here. You know, I mean, you can, but you need to adjust your money. That's why we have the money management lines. If you're trading, you know, low lot size, you can see that if you buy, your risk for 1% is down here based on you know, your guys' account. You need to adjust this for your account, but it's down here. So you can see that if you bought at this lot size, you know, and you had your money management lines spread this wide, they're well below this. So you can use that as a risk point down here and still maintain a good percentage, you know, profit or percentage risk. So that's a possibility, but look for your rotations, how you're going to enter this grade B or grade A signal, whichever it was. If you're using the assistant, then, you know, I would look at this as a reaction point right here. If you get through this one, then your next one would be down here. And put it this way, if you get much below this point right here, then this is probably going to turn yellow. If this turns yellow, then what happens to our scenario over here? It's probably rubber band action coming right back down to here. Probably. So at that point, if you buy right here, let's say you buy and you lose, you take a hit, you buy based on this expansion level, you lose right here, you get stopped out. Okay, what did we learn? We learned that this didn't hold. Why didn't it hold? If this didn't hold, what does that say about the trend on the weekly? It says it may be a little weak. Okay, now we're down to here. Maybe we give it one more chance, right? Now we lose again, and now it's down here. Now the weekly's yellow. Now this changes the whole scenario over here, and then all of a sudden it pushes down. Now you're down here, and then you get a new box right here, and now you're getting a pull up, back up to here, but now you got a yellow candle over here. That's a short opportunity to take it back down to here. So that would cause you to reverse the way you're looking at it. Again, these are just scenarios. I have zero idea what's going to happen. I would say based on Heiken Ashi candles, I would stick to the blue side as it's as the weekly's holding. I think there's a decent probability that you're going to hold at this level or this level and then turn back up and snap back to this mean. And that's the point of trading the strategy in trend. Is that, right now you're below center of gravity, you're below the balance point, and your higher time frame is blue. So that's really, we're trading the probability that we got a deviation, a counter trend liquidity against the bigger power, and that we're going to come at least back to here. So that's your, would be the original idea. But again, that's it. Those are your benchmarks. This is the first one. This is the second one. You get through there, the scenario changes.